So what I'm here to do today is to just give you a very high-level overview of the UK market, just to provide some food for thought before the debate later. So the UK market is characterised by a fairly high and typically rising level of owner occupation. At its peak, it was about 70%. This compares with about 40% in Germany. However, recent market developments have changed this, and there's been a shift away from owner occupation in favour of private rented. Now, this mainly reflects the contraction in the sales market following the aftermath of the global financial crisis. Two issues: the wider economic downturn and also the fact that there was a lack of mortgage availability. The mortgage market has recovered a little bit, but it's still only about two-thirds of its long-run size. Now, this contraction fed through to house prices. We had a massive 20% fall in about 2008 in national house prices, and subsequently we've had muted growth. Now, there has been some recovery recently. I think annual house price growth was about 8% last year. And of course, there is one notable exception, and that is prime central London. We've had double-digit house price growth here, and this reflects a lot of overseas investors and also cash-rich buyers that have been able to bypass the mortgage system. But one legacy of the credit crunch is this shift in tenure preferences. We've estimated that about 1 million first-time buyers have been unable to get their first foot on the housing ladder, and they've had to look at alternative housing solutions like the private rented sector. Although it is worth noting that pre-crash, there were some affordability constraints that were starting to feed through to the market, and this was having some impact on the tenure split in the UK. This chart shows the increase in private rented sector. There's been 1 million increase in households, which coincidentally is about the amount of first-time buyers that we've estimated haven't been able to get into the housing market over the last 5 years. And we've now got 3.9 million private rented households in the UK. So what does the private rented sector look like in the UK? It is largely the domain of buy-to-let buyers. About 75% of private rented is in the hands of these amateur investors. It's not surprising, given that it has a bad reputation for stock and a bad reputation for management. The fragmented nature of the private rented sector also makes it quite difficult for institutions to enter the market. They also cite difficulties in management and also a perceived low income yield as reasons why they haven't invested up till now. But there are opportunities for investors. It's a large market. It's 850 billion. That dwarfs the commercial market, and it is growing. But more importantly, there's a change in attitudes. Renters are becoming more discerning. These are young professionals that might have bought in the past, but now they're staying in the private rented sector for longer, and they want somewhere nice to live, and they want somewhere that's got good amenities, that's got equal room sizes, and they're really demanding this better product. I mean, up until recently, private rented sector has always been thought of as sort of the naughty middle child of the housing market. And quite frankly, the parents are fed up now and they're doing something about it. And the returns are there. Over whatever time period, residential returns have outperformed commercial and inflation. And it's less risky. This looks at the volatility of returns over time, and it shows that residential has higher returns and is less risky than many of the other asset classes. And I know Mark's going to talk to you much more later, or there is the opportunity for you to ask Mark questions later about the returns that different assets and different countries have. The opportunity for institutions is compounded by government support. The first 6 bullets on this slide here I've lifted straight from a DC Department of Communities and Local Government slide, not for any other reason, just to illustrate the fact that there is this huge support. It was confirmed in the Montague report that PRS is at the top of the government agenda. Following recommendations from Montague, they've set up the Housing Task Force to promote investment, raise standards and identify opportunities. They've also got some financial support through the Housing Guarantee and also the Build to Rent Fund. While a lack of expertise and confidence and opportunities might have put institutions off, they are gradually emerging. Typically in the UK, we've had the UK prop companies, Grangers and the landed estates like Grosvenor being sort of the main providers of PRS alongside obviously the buy-to-letters. But there are changing. More recently, we've had overseas activity, Achilles, APG, Ivanhoe Cambridge, and also the registered providers like L&Q. And I know that my colleague Alex is in the audience and he'll be able to answer any questions on specific deals and transactions that have happened, if it's not too controversial. we've looked at these different groups, UK institutions and property companies, and we've estimated there's potentially 9 billion of funds that could come towards residential investment. It's a huge amount. This is reiterated by an IPF survey. They surveyed 28 institutions, and they estimate a more modest but still significant 3 billion of funds that could come into that have actually been earmarked for residential and that could come into the market within the next 3 years. So what and where do they want to invest? The product is really important. They want unbroken blocks of between 100 and 250 units. The product is so important because it's important for the renters. The renters want equal room sizes. They want these extra amenities that I mentioned earlier. And this is what the providers are competing on. Thankfully, they're learning the lessons from the US. It's more service-led rather than the take-it-or-leave-it attitude that we've seemed to have in the UK up until now. And where do they want to invest? London has had the strongest residential returns, so there's always a desire to be in London. And if you were going to be in London, you wouldn't want to bet against Crossrail. House price growth, we estimate, is going to be huge around affected stations. However, I would discount the regions at your peril. Really, we've done some analysis. We've got a paper coming out shortly looking at the outlook on the regions, and there are so many areas in the UK that have got a high share of PRS. And if you're willing to take just a slightly different risk profile, there are good yields there to be gained. So that's me over now. If there are any questions, I'll be sitting there, I think, later. Thank you.